But hey, John, thank you for being on Coffee with Riverbend. You've been a fantastic asset for a lot of clients and people that we deal with. Tell us a little bit about what has happened so far this year in the markets and what your expectation is going forward.
Sure. Well, I would say the biggest thing that happened this year is the first 6 months of the year, the market had some positive news on two fronts. One was the thought that the Fed was close to being done raising rates, and two, that the economy was not going to go into recession. So those things generally caused the market to think more positive, more risk on. And so what you had is you had stocks last year that underperformed, a lot of the large cap growth names that started to outperform. And then you had a banking crisis or a mini banking crisis that sort of pushed people away from financials into more, I would say low debt growth companies, a la Facebook, Nvidia, not Facebook, sorry, Meta, Microsoft, Google. But on top of that, then you had this thing called AI that came out, and the potential that AI could increase productivity and increase earnings across the board. So that caused the markets to rally significantly in the first half of the year, where NASDAQ was up over like 30%, which was its best first 6 months in almost 4 decades. And the S&P was up over about 16%. In the last couple months, what's happened is you've had sort of a slowdown of that. That could not continue. You've had a more broadening of the market where industrials started to pick up because there was no recession fear. So industrials started to do well. And other names started to broaden out. Energy stocks started to do well. Unfortunately, we've come to the period of the seasonal period every year. The August through October period tends to be the seasonal check period in the market. So now you have the broadening has sort of stopped, and actually things have sort of everything's sort of gone sideways to down. The question is this the beginning of some significant, check in the market, or is this just a pullback from the overbought, market that we've had? I tend to think that there might be a little more concern in here, because what I look at is the Fed has raised rates over 500 basis points. And historically, when the Fed has raised rates over 300 basis points, you've always had some type of profit recession or some type of economic recession. So at some point, there's going to be some trouble coming forward. We just don't know when. It hasn't happened yet, but that's the risk that we're looking at right now.
What are some of the things you look for in analyzing that risk? Is there any particular indicators that are out there that you tend to look at?
Well, I mean, a lot of what we look at is we look at the individual companies. So what people don't realize is everyone, like the last quarter's earnings that came through, everyone's saying, oh, the earnings were strong. They were above expectations. They were actually down 5%. But people, they don't hear that. What they hear is they beat expectations going forward. So the absolute number was actually negative, but it's the numbers game that people said. So we actually look at companies and what they're saying, and so far, what you're not seeing a lot of slowdown. Let's take an example: Pepsi. Pepsi beat their number, great, but how did they beat their number? Their actual product, their unit sales were actually negative, which is usually bad, but they were able to raise prices by 15%. So overall revenues were up. What we see is we don't think Pepsi's going to be able to raise prices 15% for 1, 2, 3, 4, 5 more quarters. So what happens is at some point you're going to see revenues down and pricing down, and that's going to have an impact across the market. But there's always pockets of positive. Energy prices are picking back up, so that means the cash flow of energy companies looks more appealing than it has over the last 12 months as energy prices have fallen. So we sort of look at the market in general as sort of neutral-ish right now, the equity markets as sort of neutral, where we think there might be opportunities in energy. We actually think with this pullback, the technology stocks look very interesting, but we would probably wait for the pullback to be completed. On the fixed income side, things are very interesting because the fixed incomes got hit last year with the inflation scare. We would say 80% of the inflation damage or 90% is already done. So we think Fixed income is going to be the traditional, ballast in your safety net going forward. You're going to get your income plus some type of total return. And the two negatives we think out in the market right now is a profit slowdown or an economic slowdown. Both of those are positive for fixed income. So we think fixed income is going to be much better. So your balanced accounts are going to perform much better than they did last year.
Okay. Is there any particular area of fixed income that might be you're looking at?
Well, to be quite honest, the short part of the market, you cannot ignore getting 5.5% risk-free right now. The risk of that is, at some point rates are going to be cut and that's going to fall back. Yes, there's a slight chance that long-term could go up to that point, but that's not our scenario. So I think the short end of the market's sort of interesting right now because you can get 5.5%, 5% right now and wait and see if we go into that recession or not. We think high yield, as the name says, it has high yield right now. You can get 8 or 9%, but typically you don't want to buy high yield going into some type of slowdown. You want to buy high yield coming out. So we're not quite positive. The absolute yield levels are positive for high yield, but we would rather wait and see the spreads, widen a little in that. So we think the short end of the curve is a good place to be right now.
Perfect. And now we had a conversation yesterday because we were talking with a potential client, but y'all's track record has been quite impressive. And see, how many portfolios do y'all manage and how many beat their benchmarks last year and the year before?
Yeah, usually when we talk to new clients, they ask about some performance numbers. So what I like to say is we're not a bear fund that only outperforms in bear markets, or we're not a high beta fund that only performs in up markets. So in 21, we have over 25 strategies. That would be an equity strategy, a balance strategy, a blend strategy, and different asset allocations with that. And of those in 21, when the S&P was up over, I think 28%, we had approximately 85 to 90% of our portfolios outperform their benchmarks. Last year, when the S&P was down approximately, I think 18%, we had a little more. We had approximately 85 to 90% that outperformed. So we're actually pretty proud of that, because that's one of the things is it doesn't pay to just win on the upside when the markets are going up and then you lose a lot when the markets go down. It pays to be, steady, which I guess when we talk to new clients, as you know, we sort of say we like to hit the singles and doubles and batting average. And so that's sort of what we look for in stocks too. Yes, NVIDIA is up 50%, well, actually more than that this year, up 100%, but it was down over 50% last year. We try to look for stocks where I can sleep at night, you as the advisor can sleep at night, and the client can sleep at night to get the steady returns that most people need. As you know, when you look for retirement plan, you say, what can I, get a 7 or 10 or 12% returns going forward longer term? Is that sort of what you work in the numbers, and that's what we try to deliver.
Yep. And look, that type of thought process when it comes to risk management is incredibly important, especially to retirees, because when you're generating income, obviously income is important, but trying to mitigate downside risk as much as possible while keeping up with inflation is just really, really, really important. And so we really thank you for that. And I appreciate that. We also have on the call today, Dan Butler. He is an estate and tax attorney headquartered in Myrtle Beach, South Carolina. He helps a lot of people in the area and around the state of North Carolina and South Carolina, making sure their estate documents in order. Dan, welcome. You a graduate of Wake Forest. You also went to Furman, and we appreciate you being on the call here. A lot of retirees and business owners in the area, a matter of fact, around state of South Carolina, North Carolina, what are some of the top 2 or 3 or 4 mistakes that they tend to make, or things they may need to address when it comes to estate planning and their estate documents?
Appreciate that, Jeremy. First of all, thanks for having me on the call this morning. Privileged to be here. Yeah, so I get a lot of clients actually from North Carolina and from other states who end up moving to South Carolina. And I often see they often have their own estate plans from the state they're coming from. And one of the biggest misconceptions that I always hear with new clients is that, hey, we were told that, we got to do all brand new documents when we move to South Carolina. Well, that's a big misconception. There's something called the full faith and credit clause here in the Constitution. And so when you come to South Carolina with your own estate plan documents, it's actually good here, with one caveat. So typically there's 4 essential documents that most estate plan attorneys do for clients, and those are last will, healthcare power of attorney, a durable power of attorney, and a living will. And I see those oftentimes from out of state. And so really the only document that I highly recommend clients redo is the durable power of attorney. And the reason being, I see a lot of these documents have this boilerplate language that references their state statute as to the powers that an agent has on that document. And unfortunately, if you present an out-of-state durable power of attorney to a third party like a bank here in South Carolina, they're not likely just to accept it as is. They're probably going to run it up the pole to their legal department. So it's going to create some delays and possibly some rejections. And so out of those 4 documents, if you're still okay with the terms, you can keep them as is here in South Carolina and not have to do new ones. And so the only one that I would recommend would be the durable power of attorney. So to address some other things, usually, estate plan really kind of is fact-based estate planning, because obviously circumstances are different for different people, right? And so really what I look at is, what is your ultimate goal? And I tend to find 3 primary goals that I hear a lot. One is avoiding probate. And that's a very general term that they come in and they say, I want to make it as easy as possible for my spouse to receive assets or my kids to receive assets if I died, right? And one of the ways to do that is to avoid probate, because for your listeners who don't know what probate is, it's the legal administration process that basically transfers a decedent or a person who died, their assets to their heirs. And here in South Carolina, it's about a 1-year-long process where you file a will, you appoint an executor, the executor makes certain filings with the court, like inventories and such. And then you deal with creditors and possibly other claims. And then once you deal with all that, whatever's left in the estate is then divvied up and given to the heirs. Now, there's nothing wrong with that. And it's, relatively easy. But there's a lot of ways you
Keep
can
in mind, Dan, it's easy for maybe you, right? So, like
Right.
if the surviving spouse, when that happens, especially if it happens tragically, which happens generally about 4 times a year for our clients, it's a shock,
Sure.
and to trying to make that as simple as possible is certainly a tremendous advantage that you bring.
And there's a lot of simple things that retirees who tend to be retired couples can do to avoid probate if one of them were to pass away. And these are a lot of things that you don't even need an attorney for. So let me give you some examples. So if you break down the types of assets someone owns, let's start off with real estate. Okay. Oftentimes I see retirees owning 1 or possibly more real estate, right? One of which is their primary residence. So I always make sure to check the deeds to their house, their residence, and any other real estate. And here in South Carolina, you have to have specific language called joint tenants with rights of survivorship. What happens is if you have that language in your deed to your house, for example, if you have both names on the deed with that language, if one person dies, it automatically vests in the surviving spouse. So you don't have to deal with probate on the real estate. Very easy to do. If you don't have it already set out that way, simply contact our office. We can do a simple quit claim deed where we would add the spouse who is not currently on the title. Another asset base is vehicles. And this is something very simple, and over span of years, I don't understand how people don't understand the difference between the verbiage of or versus and, because it makes the biggest difference with vehicles. So vehicles, they have a certificate of title, right? And oftentimes retirees have their own separate vehicles, and one is titled in one spouse and the other one is titled in the other spouse. Well, obviously, if one spouse dies, you have to probate that spouse's vehicle in probate court, right? And so one way to avoid that is to go ahead and add your spouse's name to the vehicle title. And in the box where you check and or, pick or. Okay, very important. You check the box that says or. So just like with the right of survivorship with real estate, if you have a title to a vehicle that has 2 names with an or, when one person dies, it automatically belongs to the survivor. Nothing has to be dealt with in probate. Okay.
Wow.
And finally,
Wow, that's
one of
good.
the,
That's a very, very good point. Uh, question, like for a lot of retirees are here, let's just say in the Grand Strand area, and they pass away, and then you have what you end up having is you have children that are out of state, and they're dealing with things like cars. Any like what are some of the things they need to be thinking about? How do they manage the distribution of those assets being out of state? I mean, is there anything you can give them guidance on around that?
yeah, I mean, it kind of depends. If the goal is to avoid probate and have the kids receive these assets immediately after the deaths, rather than going through the probate process, there's a couple of options there depending on the assets that you want to have transferred to your kids. And one of the biggest estate planning tool that's available for everyone, not just the wealthy, is a trust. So for example, when I go back to the two assets we talked about, the real estate and the vehicles and whatnot, if you set up a trust, right, and then you transfer title of the real estate to the trust, if one spouse dies, the spouse continues to be a trustee of the trust and it avoids probate. And then when that spouse dies, so there's, nothing left there, no trustees, they would simply name their kids perhaps as trustees, or even a bank like Bank of America as trustee, they would take over. And if the trust agreement says all of my real estate goes to my kids, it avoids probate. They don't have to deal with probate process here in South Carolina, which is especially important for out-of-state children.
Mhm.
And they can receive the title almost immediately after deaths.
Makes it nice and easy.
Absolutely.
Makes it nice and easy.
And one final tidbit, Jeremy, with bank accounts. Oftentimes retirees have joint bank accounts, right? One thing they don't realize though is there's something called a POD or TOD that they can reflect on their bank account. It's called paid on death or transfer on death. It's an easy way to avoid probate for funds that are in these joint accounts. And if they name their kids as POD beneficiaries, they would receive the funds upon submission of a death certificate rather than having to go through the probate process. So.
Okay. Perfect. Thank you very, very much. Now, there is a question and answer, a Q&A field here for those viewers / listeners. And so if you got questions, certainly feel free to type your questions in there. And so, very good. Can you mentioned about the 4 documents, right? So for those listeners out there, can you go over what those 4 documents are, the basics and then what each of those documents mean?
Gotcha. So the 4 essential documents that I highly recommend really everyone needs to have. One is the last will and testament. Now, this is a document that kind of dictates who's going to be administering your estate and where your assets are going to be distributed. And so basically it would say, I can name my spouse as an executor and my kids as successor executors. And then I want everything going to my spouse if she's alive. If not, it goes to my children. Those are the very typical simple wills that you find out there. Second document is a durable power of attorney. So in a situation where you need someone to step in and help you with legal and financial matters, this is the document where you appoint someone to be authorized to do these things that you could do yourself. So it includes things like, paying your bills or dealing with any legal matters or dealing with any tax issues with the IRS directly. Again, the scope of the authority obviously is going to depend on the scope in that document, but that's where you authorize someone to handle your legal and financial. The healthcare power of attorney deals with health issues. So in a situation where you become incapacitated, you're authorizing someone to make these very important health decisions for you that include things like life support, medications, surgeries, things of that nature. So anything where a hospital needs permission, they go to your healthcare power of attorney for authorization permission. Yeah. And the final document is another health document. It's called a living will, also known as a declaration of a desire for a natural death. Basically, it applies in 2 situations where you're either terminally ill and you have 2 doctors who say you don't have much long to live, or the other situation is you're permanently unconscious, which is another way of saying you're basically brain dead. You're saying in this document that if either of these 2 situations exist, you don't want life support, and you don't want anyone putting you on life support in either of these situations because you want to die what they call a natural death. Without this document, For liability purposes, obviously, a lot of facilities will automatically put you on. And of course, it'll be subject to any decisions made by healthcare power of attorney as well.
Yeah. Yeah. It's, and it's, not necessarily cut and dry stuff. Right. So, what we do over here, Dan, and you know this, right? Is when we do holistic planning for comprehensive planning for clients, and we try to get a real good understanding of what they want to accomplish. A lot of times, you know, the client or the clients, they'd say, hey, I just simply want to, you know, live my life and spend time with my kids or grandkids, right? But it becomes much more complex than that. Like, oh, have you updated your estate documents like you're talking about? And like bringing in John, for instance, here in Fundamentum and his team. Okay, are the assets they have to generate that income, is it optimal based on what their goals are? And so, you know, what we tend to do is rely on your expertise in your respective fields to make sure that all those boxes are checked. Now, fortunately for the clients, they don't have to go and do everything themselves, right? You know, they, you know, that's one thing that you guys help us do and collectively helping the clients make some good decisions. I had somebody come in the other day, and this is an example of where, like, you know, Danny, you're a tax attorney, and we also work with CPAs as well, is like a lot of things that really make a difference to the client need to be done within the calendar year. Because after December 31st, you can't take tax losses or tax gains. You can't do qualified charitable distributions from IRAs. There's a lot of things you can't do. And so what we try to do is look at those things throughout the year. We met with someone recently, and they had some low cost basis funds. They were able to take some capital gains and pay virtually zero tax because they had primarily just Social Security. And so they missed that last year. But them taking advantage of it this year probably saved them at the amount of the assets they have, maybe $30,000 in tax. So what I like about what I want to stress is that Danny, your expertise, John, your expertise, and the expertise of the CPA, and then what we tend to bring collectively make sure that the clients have the proper boxes checked. A lot of times they don't know it. You know, it's like a child, you know, and I don't mean that disrespectful, but, you know, sometimes the kid doesn't know the risk involved because they don't know. But when we are able to bring in y'all's expertise to make sure those boxes are checked, then estates can get transferred with the least amount of tax as possible. You know, beneficiaries in the state of Virginia or North Carolina or anywhere in the country can facilitate that as easy as possible. John, and your expertise, you can navigate these markets.
Right.
It try to be as fruitful as possible. Yeah.
Well, one of the biggest things we see is procrastination, where they say we're going to make this investment decision, or we're going to do our will and testament next year, and then all of a sudden something happens, and oops, and you don't want that oops scenario to happen.
100% the case. 100, and so like we were meeting, we meet with people all the time. Okay, you know, like if they're on vacation, right, and there's something happens in the markets where, you know, you're a moderate portfolio, and there's something happens within the markets, the interest rates or whatever, John, you're able to pivot and take advantage of that or protect, right? You know, and it's just like I like to put it this way: if I'm hitting turbulence and I'm on a plane, I don't want to go grab the wheel of the plane. Let the pilot do its job. You know, so that's kind of the scenario there. And then also life happens, right? Unfortunately I had a dear friend of mine pass away in an accident 4 years ago, and he had some things in order, but a lot of things he did not have. So we always think we're going to live forever, but we've never had one person live forever. All right. It's going to happen to us all. And so getting those things in order sooner rather than later alleviates some burden either now or in the future, either for yourself, your spouse, or your children. So, yeah. Any questions out there in the viewing and listening audience? Questions? Anyone? All right. Hey, Dan, is there any, isn't there some expiration in tax rolls that are going to be changing in 2025? Anything around that you may want to comment on?
I believe you may be referring to the estate tax exemption,
Yeah.
which may sunset on that period, and don't have the current. Right now, the current federal estate tax exemption is over 12 million per person. What that means for the listeners out there, if you passed away and the total value of your probate assets and non-probate assets are over 12 million, you'll be taxed at the federal estate tax rates for the amounts above that. So for most of my clients, they don't have to deal with estate taxes when they pass away. In the past, historically, the estate tax exemption has gone up and down. It's gone to as low as $1 million or below. I think it used to be 5 million a couple of years back. And so we're in a period where we've got a lot of exemption to work with. In 2025, it may not be there anymore if legislation is not updated to continue it. I think it reverts back to $1 million at that point. And there's going to be a lot of estate planning in place going on before 2025, if in fact it does sunset and no legislation is passed.
So there are some things that the clients and listeners may need to do.
Correct.
To take advantage of, or prevent the risk of those sunset provisions in their estate planning documents.
Yeah, and I remember, I think I read that it may sunset. It doesn't actually go down to $1 million; it goes down to 7 million. Now, for a lot of clients, that's still fine, right? But for some sector of clients out there, it may affect them.
Well, I mean, if they have a, John's expertise, your expertise, my expertise, 7 million's nothing. Yeah. Okay. Yeah. For the compliance listeners out there, that's a joke. Okay. No guarantees. Right. Okay. So I'm going to talk just very briefly because about Medicare. I'm going to share my screen real quick for the listeners and viewers out there. There's really mainly two options with Medicare. You got original Medicare, which is Part A, which is hospital insurance coverage. Part B is usually services like doctor's visits and preventative care. And then what you have is an option. By the way, you really need to look into signing up for this at least 3 months, right at 3 months before your 65th birthday. So, but optionally, and they say it's optional, don't think of it as an option. You need to sign up for Part D, even if you don't take any prescription drugs. D is for drugs. And the reason for that is that in the event you need drug coverage at a later point in your life, you may have to pay a lot more money. So sign up for Part D, just choose the cheapest plan. And then Medigap, guess what they do? They cover the gaps in Medicare. Think of them as like they're paving the potholes on the road. All right. For all the drivers in South Carolina, there's a lot of potholes. And so what the Medigap does is cover some of those potholes. The other option, the way you can get Medicare insurance is through a Medicare Advantage plan. Basically, Medicare pays the insurance company for the Medicare Advantage plan, and then they manage your care, which means you got to know who the network doctors are, hospitals are, services are, and then they can have optional coverage for Medicare Part D, D for drugs. And so if you're shopping for a plan like that, it's very, very specific. Make sure you're not overpaying. Okay. Sexy stuff there, gentlemen. Okay. Any questions? Final questions? Well, all right. So John, parting shots, final thoughts before we.
Well, I guess what I would expect is we'll probably have some turbulence in the markets in the upcoming couple months. You have the Jackson Hole, which is the big Fed, meeting where all the bankers come together. Usually some fireworks there. The question right now, the markets think there's about a 30% chance that the Fed raises rates in their September meeting. I probably would go on the higher side of that. But I do think the Fed is in the 9th or 8th inning of raising rates. And so I think going into next year, the year after, things are looking a little more bright. So I think people should start, I would say, move your battleship to prepare for more clear sailing than the turbulence we've had over the last 18 months.
Perfect. And for those clients out there, we're doing that. And guess what, John, you're doing that for us, right?
That's yes.
And we're doing that as tax efficiently as possible. We're looking at all those things that we just discussed in that regard. Dan, any final thoughts on what listeners need to be thinking about?
Yeah, for those listeners out there, a lot of you guys already have an estate plan, and that's great. You're already, you're ahead of the ball game in front of a lot of folks. But if you haven't had it reviewed lately, I would say within the last 2 years, had it reviewed. I mean, the worst case scenario is they tell you need to update something. The best case scenario is they say everything looks great. But if you do this every couple of years, I think you're going to sleep a little bit better at night, I think. So
perfect. Well, how would they contact you? I mean, what would be the best way for them to contact you if they want to give you a call and, hey, have you have a quick review?
Yeah, so I have a website. It's www.butlerlaw.net. Very easy to remember. Check on there. There's a phone number there. Give us a call. We'll set up a consult. Consult with my office is free. So if you want to bring your estate documents, I can actually review those with you and let you know if they're good. And I can make some, proposals. If you don't take it, it won't hurt my feelings. So.
Wonderful. Hey, one of the things that's really good about when we work directly with an estate attorney like yourself is that we usually get the estate documents in digital form, and then we're able to share those directly with you, and you have those reviewed. And if you need to make adjustments, and when you make those adjustments, we execute those documents. A lot of times, and Dan, you've mentioned this, that someone may go through a full estate plan and then they leave it sitting on their desk. They don't really execute. And what I mean by execute, actually open up the trust account, moving the assets into the trust account, things like that. And that's what we do, right? It's like having a Ferrari and it stays in the garage. Hey, take it for a spin. Make sure you use it. Well, John, Dan, thank you very much for joining us for Coffee with Riverbend. Hopefully the listeners found this useful. If you got any questions, comments, or anything, call us at 843-970-1049 or email me at jeremy@riverbendwm.com. I'm happy to help you or answer any questions that you have. Take care and have a great week.